Picture this, it's the roaring 20s. The streets buzz with optimism, factories hum at full capacity, and the stock market climbs higher every single day. People rush to brokers, mortgaging their homes, borrowing money, buying shares on margin, all convinced the good times will never end. Then, without warning, the foundation crumbles. Panic erupts. The Dow Jones crashes 90%, wiping out fortunes overnight. The Great Depression begins. But here's the haunting truth. The warning signs were everywhere. Overvalued stocks, rampant speculation, excessive debt, yet they were ignored, dismissed as temporary hiccups. This isn't just history, it's a blueprint. Fast forward to 2000. The dot-com bubble inflates on dreams of internet dominance. Companies with no revenue command billion-dollar valuations. The mantra is this time it's different. Then reality strikes. The Nasdaq plummets over 80%, vaporizing $5 trillion. Again, the red flags were visible, skyrocketing PE ratios, irrational exuberance, a frenzy to buy anything with a calm domain. And yet the cycle repeats. In 2008, subprime mortgages hide behind complex financial products. Banks gamble with borrowed money, believing housing prices will never fall. Then they do. Lehman Brothers collapses. The global economy teeters. The pattern is undeniable. Every crash follows a predictable rhythm: euphoria, denial, collapse. But why do we keep falling for it? Because human nature doesn't change. We're wired to chase gains, to follow crowds, to ignore danger until it's too late. These crashes aren't random. They're lessons we refuse to learn. The question isn't whether another crash will come. It's whether you'll see the signs when it does. The engine behind every market bubble isn't just greed. It's deeper, more primal. Imagine watching a stranger strike gold, then another, then another. Your neighbor buys Bitcoin at $60K, then sells at $70K. Talks of blue sky, profits flood every headline. You scroll through social media and see luxury cars, penthouse views, influencers smugly flashing portfolios that doubled in weeks. The fear of missing out grips you. What if you sit out and regret it? What if this is the moment? That's the emotional trap. Every bubble starts with a seed of truth, a new technology, a cultural shift, a surge in demand. But then psychology takes over. The seed grows into a fever. Rational analysis gives way to herd behavior. Investors aren't buying assets, they're buying stories. The dot-com bubble saw Pets.com raise millions for a sock puppet. The housing bubble turned starter homes into speculative commodities. Even the 17th century tulip mania, a single bulb fetching the price of a mansion, was fueled not by intrinsic value, but by collective delusion. And when the music stops, the same emotions flip. Greed becomes panic, confidence turns to hysteria. People sell not because they understand the fundamentals, but because they can't bear the pain of loss. The cycle isn't about money, it's about the human heart. Now, let's redefine your lens on market dips. A pullback is a brief cloud in a blue sky, a 5–10% drop that corrects overheated prices. It's natural, like exhaling after a deep breath. Investors who panic during pullbacks often miss the rebound, locking in losses that would have recovered. But a crash, that's a hurricane. It's a 20% plus collapse, sometimes over months or years. It erodes confidence, ruins livelihoods, and leaves scars. The danger lies in mistaking the two. During the 2018 correction, the S&P 500 dropped about 20%, stirring fears of a crash. Those who fled missed the 27% rebound in 2019. Similarly, in 2020, the pandemic crash saw a 34% drop, but the market surged back within months. If you assume every storm is a Category 5, you'll never build wealth. But if you ignore the Category 5s, you'll drown. Recent market calm, the sideways drift of 2023, feels reassuring. But beneath the surface, over-leveraged companies, central bank tightening, and speculative manias brew. The crowd whispers, buy the dip, but not every dip ends in a V-shaped recovery. Understanding the difference isn't just strategy, it's survival. Beneath every crash lies a hidden fault line, a vulnerability no one sees until it breaks. In 2008, it wasn't just subprime mortgages, it was the unchecked derivatives built on them. The system was leveraged 30-1. A small crack became an earthquake. Similarly, the 1987 Black Monday crash wasn't caused by rising interest rates alone, but by automated trading algorithms turning a 2% drop into a 22% freefall. Hidden risks compound quietly: corporate debt-to-equity ratios, concentration in a few flavor-of-the-year stocks, over-reliance on passive ETFs. In the 2020s, AI stocks soar, but how many companies have real profits versus vague promises? The danger is what's priced in, it's what's invisible. Like a ship steaming ahead, unaware an iceberg lurks just below the surface. Here's the truth that separates legends from speculators. Time in the market beats timing the market every time. History is littered with brilliant minds who predicted crashes, but went broke waiting. In 1996, Alan Greenspan warned of irrational exuberance in equities years before the dot-com crash. Investors who sat out missed the run-up, locking in mediocrity. Compounding doesn't work if you're on the sidelines. Consider the S&P 500. Since 1980, it's returned 11% annually, but if you miss the top 10 performing days, your return drops by half. The lesson: staying invested is a mental discipline, not a math problem. You'll need to ignore the screaming headlines, the FOMO of crypto bros, the fear when your portfolio ticks red. It's not about predicting the storm. It's about building a ship that can weather it. Price and value, two words investors confuse at their peril. Imagine a bakery. Its ovens are new, customers line up, and free cash flows pour into the register. But one morning, the stock price dives 30%. Did the bakery's value drop? Not necessarily. Maybe a rumor spread, or a short seller attacked it. Maybe the broader market panicked. Price is a vote, value is the math. Fundamental analysis strips away the noise. It asks, what's the company's debt? How consistent is revenue? Does it generate cash or burn it? Amazon lost money for years, but built a fortress in cloud computing. Short-term price swings ignored that foundational shift. Value investors don't care about stock charts, they care about balance sheets. They buy dollars for 50 cents, then wait. Case in point, Amazon and Cisco. Amazon stock dropped 95% from 2000 to 2001 as dot-com collapsed. Yet its business thrived, sales grew, Warehouses expanded, cloud computing experiments began. Investors who fled lost out on 25x gains over the next 2 decades. Cisco tells the same story. By 2000, it was the world's most valuable company, powering the internet's backbone. Revenues doubled in 2 years, but its stock cratered 80% post-bubble. Why? Price outran value temporarily. The company survived and prospered, but their stocks punished those who bought at the peak. Growth alone isn't enough. Timing and valuation matter. Every bubble follows the same fatal arc. First comes displacement, a new narrative like the internet in the 90s or crypto today. Suddenly, everything will change. Then boom, prices rise, early adopters profit. Rationalizations flood in. Land has intrinsic value, housing never drops. Next, euphoria, your dentist mentions. NFTs, cab drivers give stock tips. The greater fool theory reigns. You buy not for value, but because someone else will pay more. Then profit-taking, insiders quietly sell. In 2000, Cisco's CEO dumped shares months before the crash. Finally panic, cracks spread. Margin calls ring. Everyone flees at once. The aftermath. A decade of skepticism until the next cycle begins. This is the greater fool theory. You buy an asset not for its worth, but in hope of finding someone even more naive. Bitcoin, NFTs, meme stocks, they thrive on hype, not earnings. In 2021, Dogecoin, a joke cryptocurrency, hit $86 billion market cap because a tweet said it would. Speculators chase returns without asking, what's the value? The difference between this and real investment. Productivity. A factory produces cars. A farm grows food. A tech company improves efficiency. Bitcoin secures transactions, but most buyers hold it as a promise, not a tool. When the music stops, fools are left holding the bag. The solution lies in principle-driven investing, a philosophy that prioritizes patience, discipline, and logic. It begins with understanding value, avoiding overpaying, and diversifying not just across assets, but across styles, growth, dividend, international. It demands humility, selling winners before ego takes charge, buying losers with courage. Most importantly, it's about aligning your portfolio with your life goals, not Wall Street's narrative. Enter dollar-cost averaging, the unglamorous strategy that beats 99% of investors. By investing fixed amounts regularly, say $500 a month into the QQQ, you buy more shares when prices drop, fewer when they rise. Over 20 years, this approach compounds without timing luck. In 2020, those who kept buying despite the crash saw 100% gains by 2021. It's not magic, it's math. Emotionally, it's a lifeline. No anxiety about market peaks, no regret over perfect entries. Just consistency. Finally, the greatest skill isn't analysis, it's peace. Markets will always overflow with noise, gurus shouting buy, sell, crash. Algorithms amplify fear. To thrive, you need filters. Focus on what's timeless, saving aggressively, living below your means, rebalancing annually. When your portfolio dips, think of it as a sale, not a disaster. Crashes are opportunities to buy tomorrow's winners at 50 cents on the dollar. If you're young, downturns are gifts, a chance to deploy capital at lower prices. If you're retired, have a cash buffer. Either way, calm is your edge. ready to join the ranks of those who profit when others panic. Watch my video on spotting undervalued stocks and enroll in my comprehensive course to master every tool you need. Links below. Stay curious. Stay disciplined. The next crash is coming, but now you'll see it coming too.